Hi everyone, Mark Whitaker here, the Early Retirement Advisor, and today we are going to talk about two of my favorite subjects, Social Security income and taxes. And the only thing better than talking about these two topics is to do it together. So when you are planning for your retirement, whether you're wanting to retire at a more traditional age or earlier, a good plan has to take into account taxes. With Social Security, there are special tax rules that you really need to understand in order to do a good job with tax planning. So that's what I want to go over today. There's something called provisional income, and this is the method that's used to determine how much of your Social Security income is taxed. And I'm going to go through this pretty concisely to give you an idea of how it works, because if you understand how the rule works, you can then use that information to better tax plan in retirement. So the first thing that you're going to do is look at your adjusted gross income. This is a line you can see on your tax return, but that's the number that you start with. Now, from that, you subtract out all of your Social Security income, assume no Social Security income. Also take out some things that are normally not there, but they are included in AGI for purposes of determining your Social Security taxation. That's things like the main one is tax-free bond interest. So if you have a portfolio of municipal bonds, you don't have to pay federal income tax. You have to include that income as part of this special AGI number. Then you're going to add back in half of your Social Security income, and that will give you this provisional income number that will be used to determine how much of your benefit from Social Security is taxed. And this is this taxation can swing widely. So the taxation of Social Security can be anything from all of it's tax-free to only a small percentage, 15% being tax-free. And so dialing up or down your provisional income number is what's going to make the difference, whether 0 or 5 or 10 or 15 or 20 or up to 85% of your benefit is subject to tax. So one of the things that I want to talk about, or that I'll just kind of share in this quick video, is that when you're planning for your income in retirement, you really need to map out your cash flows year by year, because not only do you need to make sure that you're going to have enough assets and income sources to cover your income over your entire lifespan, but you can also then map out your different income sources, because your sources of income will impact this provisional income number. So for example, if you wanted to have $100,000 of net income into your bank account each year, you could have those distributions or that money come from rental income, from part-time work, consulting work. It could come from taking distributions from retirement accounts like an IRA or a 401k account. It could also come out of a brokerage account. Let's say that you've invested in a brokerage account and that money you've put into the account had already been taxed, and over the years it's had capital gains and interest income perhaps. So if you were to take money out of that brokerage investment account, a portion of that is not taxed. You may have $10,000 coming into your bank account, but not necessarily have $10,000 of income to report, because you're essentially getting back some of your cost basis in that scenario. So understanding the way that provisional income works for Social Security will allow you to then make better tax decisions, not just this moment in time, but preparing for retirement, in early retirement, and in later retirement. So I hope this is helpful. Check out the blog to read more details. I've got good information there, and I wish you all the best in your plans to have a great retirement.